Welcome back. And in today's video, we're going to talk about one of the largest companies in the world and an industry that doesn't get talked about very much. Those being the luxury goods business and LVMH, one of the largest companies that sells these luxury goods. Now with that, let's get right into it. Now the richest person in the world is Bernard Arnault, at least as of right now. And he made his fortune selling a wide variety of luxury goods. And many investors are usually hyper-focused on either lean techy businesses with fast growth or low multiple value plays. But what many investors don't give too much attention to is luxury brands like LVMH that have outperformed the broader market by over 158%, not including dividends, in the past 10 years. The main reasons I believe investors shy away from these companies and this pretty much industry as a whole is because of two main reasons. That being the risk of value loss during a recession where luxury goods are maybe not needed as much, and the lack of essential nature that they have with designer clothing and perfumes not being on the top of a list during a recession and many other periods of time. And in this video, I'm going to try and explain the truth about these 2 points and then show a compelling case for why LVMH and luxury goods in general will outperform the broader market and offer superior returns to investors. Now first, addressing what happens to these companies in a recession. Well, many investors like to consider the downside risk in the case of a recession when determining where to invest their money. And this is for good reason, as large drawdowns are often what most investors are really trying to avoid, especially as they get older in age. And the concern is that these luxury goods companies might suffer disproportionately during a recession when compared to other companies and sectors that are more demanded all the time and seen as more essential. With that in mind, it may be prudent of investors to go back and look and see how they did during different recessionary periods, like 01, 2008, and maybe even during COVID in 2020. So let's take a look at their revenues through these recessionary periods. Now, looking at this graph, if you were concerned about luxury brands or LVMH specifically taking a harder hit than most other retail brands, then I think this chart showing their steady revenue growth through pretty much every environment proves that they are very resistant to the effects of the broader economy. And we can see that right before 2000, there was somewhat of a dip, and then even through 2000, 2001, 2002, we saw steady increases, and all the way up until around 2008, 2007, where we saw another stagnation and kind of a dip lower. And then in the past 10 years, we've seen it skyrocket upwards, all the way up until 2018. Now, LVMH is just one company within this larger sector and industry of luxury goods and services. So let's take a look at Hermes and see how they did. Now, as we can see, in 2007, 8, and 9, they were able to grow their revenues each and every year. And then continuing 10 years after that, they've continued to grow their revenues consistently and at a pretty staggering pace, all the way up until 2020, where they took somewhat of a hit down from 6,800 to 6,300. And then during 2021 and 2022, pretty sizable jump all the way up to 11,000. As we can see, this is just yet another case where revenue only went down in 2020 when their retail stores were physically closed and they were not allowed to operate a significant part of their business. Now, overall, I don't think these companies are immune to recessions by any means, but it is clear that they are not disproportionately affected compared to other retailers or even the broader market in general. Now, another key point and reason why I think investors shy away from this industry and luxury goods companies in general is that they just aren't indispensable during any economic time period, whether we're booming or even busting. But I think those people who are looking at it that way are missing a huge point. And although most of the population sees little need for these types of luxury goods, items, or experiences, it is clear that there is strong demand for these products no matter what time period. And as we saw in those last two graphs, there was also no problem at elevating those revenue numbers no matter the time period or the macroeconomic environment. The main hurdle for people who don't really understand why people spend their money on these luxury good items, including myself, is the rationale behind buying some of these overpriced items. And we say overpriced, but is it really overpriced if the supply continues to meet the demand and people continue to buy all of the stuff that is released by these companies? Now, although there is no perfect way to understand human nature, I think it is best approached when you look at society throughout history, where we have always been those who wanted to show their status by the clothes and the items they had, as well as those who pursue the latest fashion trends. And when you look at these companies, not as companies who are providing very useful products to their customers, but instead as brands that provide status for their customers, And if you're able to see it like that, then no matter how bad the economy gets for normal people, there will always be a top 1% or even top 0.01% that will desire the best quality or luxury that these brands can offer. Another interesting aspect to consider when investing in luxury brands is that luxury prices tend to inflate faster than regular goods. This occurs because when the money supply expands, it disproportionately affects different classes of people, and the money gets to the upper class before it gets to the lower class. Now, to further expand on this point, let's take a look at how the money supply has grown in the United States since around 1959. We can see that it was around $286 billion in 1959. And then fast forward all the way to 2023, we see that it's at $20.9 trillion. Now, what does that really mean? What's the actual growth number there? So if we plug that in to see what the compounded annual growth rate is, 286 to 20, 902, in over 64 years, we've seen a near 7% increase in the national monetary supply. Now, what does that mean? Well, we have inflation historically around 2 to 3%. Well, how can that be if we're expanding the money supply by 7%, but yet it's only 2 to 3% for everyday people and for regular goods and services? So I think it's pretty self-explanatory as to how money gets to the upper class before it gets to the lower 90% of people. But to explain that just a little bit, when the money comes into the system through the banks, they loan out to people who are creditworthy, and the people who are the most creditworthy are the upper class. And they'll spend their money on yachts sometimes, or large, nice houses, and they'll invest their money prudently in stocks and bonds. So as we see this money flow into the housing market and into these luxury items market and into boats and yachts and things of that nature, we see the prices rise for only those goods. But your can of beans or vegetables and meat at the store don't rise in the same way that those luxury goods do. Now, I know, you get it. Rich people get more money than poor people when the money printer goes burr. But what does that mean for luxury good brands and services like LVMH? Well, it means that they can continue to raise their prices at a faster rate than inflation because their customers and their clientele has more money because of this way that this system is run. And although this is a recipe for wealth gaps and increased polarity between political parties and classes, it is near undeniable that this does have a very good effect on luxury brands and services and offers them a superior business quality when compared to every other business who can't continuously sell to this class of the market and consumers that have this much discretionary income. Now, continuing with those ideas, are luxury good brands even worth investing in? Luxury brands are part of the market that I don't see covered very much, and it must be because of the reasons we've stated before of lack of systemic importance when compared to companies that supply our food, water, internet, and other day-to-day necessities that make our world go round. But I think that there's a good amount of opportunity that lies within finding businesses, industries, companies that are just not followed on a mainstream level for whatever reason. Whether they're considered too boring, like some industrial companies, or if they're just kind of written off because they're in an industry that people just aren't interested in. I think it's worth taking a second look and seeing if there's any opportunity that lies within there. And although these luxury brands are maybe not a necessity, I don't think that that's what we should be investing for. We should be investing to get the highest return on our capital, regardless of our interest within that business. And if you invested in LVMH and Hermes, you would see that you would have gotten a superior return of over 218%. Just in the past 5 years alone, and with LVMH, over 141%, which both continuously beat the S&P 500 over long periods of time. And not only have they grown their revenue, but their EPS growth as well is another important metric. As we can see if these companies are diluting their shareholders or if they're growing their earnings organically over time. And over the past 5 years, LVMH has grown its EPS at a CAGR of 17%, which has been highly accretive to shareholders. They have also maintained a fairly flat outstanding share count, which has been part of the reason that their EPS has grown so quickly, as they don't seem to be raising capital via stock offerings or doing excessive stock-based compensation. Another obvious but worth mentioning point for these companies is that they have massive margins on their products, as they can achieve gross profits as high as 70% regularly, which represents their immense brand value. This tech-like gross margin allows them to also have tech-like returns, as a lot of their revenue falls to the bottom line. Now, although I don't know what the future has in store for these companies, I do know that there will always be a demand for luxury goods and services because of people who want to buy status symbols, collector's items, and just general luxury experiences. I also believe that these two companies are two of the biggest players that will be able to benefit from the growth in this market as wealth gaps continue to grow and the government continues to print more and more money. Now, this isn't investment advice, and I'd be really careful entering into a company like this, because who knows if there's another recession around the corner that could really impact these businesses and maybe even affect the discretionary income that they usually receive from these higher class, higher income individuals. So do your own due diligence and see if you believe that these companies are superior. Now, that's all I have for you in this one. Thanks for watching. I'll see you in the next one.